Welcome to our presentation on disclosures and notes quality. How can we ensure our financial reporting is both transparent and compliant? Let's delve into the key strategies. Unveiling the intricacies of creating accurate financial disclosures is essential for organizational integrity. With clear and concise reporting, companies can build trust and credibility with stakeholders. Let's explore the vital role of transparent disclosures in financial reporting. Stay tuned for insights that will revolutionize your approach to disclosure quality. Ever wonder what lies beyond the numbers on a financial statement? Enter financial statement disclosures, the unsung heroes that shed light on the why behind the what. Detailing accounting policies, risks, and uncertainties, these disclosures are not just a nice-to-have, they're a necessity. By providing transparency, they build investor confidence and empower stakeholders to make informed decisions. So, next time you glance at a financial statement, remember, the devil's in the details. Uncover the story behind the numbers. Ever wondered about the secrets hidden within financial statement notes? These notes are not just supplementary, they are the backbone of a company's financial narrative. They start with defining how financial information is measured and reported, the foundation of transparency. Then, they delve into the specifics, breaking down key items on the balance sheet and income statement with supporting details. But wait, there's more. Risk disclosures shed light on uncertainties and potential impacts that could sway the company's future. And finally, supplementary information adds layers of context, from related parties to segment data. Each section plays a crucial role in painting a comprehensive picture of the company's financial health. Welcome to Chapter 2, where we dive into the power of disclosure checklists as your quality control tool. Picture this, a comprehensive roadmap ensuring every required disclosure finds its place in financial statements. These checklists, tailored by accounting standard, such as ASC 606 for revenue or ASC 842 for leases, leave no room for omissions. Companies craft them to fit their unique circumstances, streamlining the quality control process. Think of it as your compass through the intricate world of accounting standards, safeguarding completeness and accuracy. Ever wondered how disclosure checklists streamline financial reporting? First, pinpoint the relevant accounting standards for your company. Next, meticulously review each standard's disclosure requirements. Document where each disclosure is found for an organized audit trail. Lastly, ensure accuracy with a thorough quality review. Having a second set of eyes can catch any oversights. So, are you ready to elevate your disclosure process? Stay meticulous, stay compliant. Ever wondered how disclosure checklists could revolutionize your reporting process? Let's dive in. First, completeness. These checklists ensure you cover all necessary disclosures, reducing the risk of non-compliance. Efficiency follows, streamlining the process with a clear roadmap. Consistency is key, fostering uniformity and aiding year-over-year comparisons. And don't forget documentation. These checklists provide concrete evidence of due diligence for auditors and regulators. Embrace the power of disclosure checklists for a smoother, compliant, and well-documented reporting journey. Ever wondered how companies make crucial financial decisions when faced with uncertainty? In Chapter 3, we delve into critical accounting estimates, the cornerstone of financial judgment calls. These estimates, ranging from bad debt provisions to equipment lifespans, wield significant influence over financial statements. Companies must navigate this intricate web of uncertainty with transparency and skill, laying bare their estimation methods and potential impacts. Think of it as predicting the future with numbers. Uncertainty is the name of the game here, and the stakes are high. Ever wondered how companies make crucial financial decisions behind the scenes? From predicting future warranty claims to calculating tax liabilities, accounting estimates play a pivotal role in shaping a firm's financial landscape. Imagine the precision needed to determine which customer invoices may go unpaid or which inventory items have lost value over time. It's a delicate dance of foresight and analysis, where every decision impacts the bottom line. Assessing asset depreciation, warranty obligations, inventory obsolescence, and goodwill impairment require a keen understanding of market trends and historical data. Each estimate is a puzzle piece in the larger financial picture, guiding business strategies and ensuring fiscal health. In the world of accounting, the future is as important as the past, and these estimates serve as a compass for navigating the complexities of modern commerce. And remember, in the realm of finance, foresight can be just as valuable as hindsight. Ever wondered what goes into crafting high-quality disclosures about critical estimates? It's not just about the numbers, it's about clarity and transparency. First, provide a clear description of what you're estimating and why it's vital. Then, dive into the methodology, outlining the approach and assumptions behind the estimate. Next, consider sensitivity, how changes in assumptions could impact financial statements. Finally, address uncertainty by explaining factors that could sway results. By mastering these elements, you empower users to grasp the methodology and navigate the uncertainties. In the world of critical estimates, precise disclosure is key. Ever wondered how companies account for potential unpaid invoices? Meet the allowance for doubtful accounts. Picture this: a financial safety net crafted from historical data, economic climate insights, and close scrutiny of key customer accounts. As of December 31, 2024, this safety net stood at $500,000, equivalent to 2.5% of total accounts receivable. But here's the kicker: a mere 1% increase in bad debt would mean adding a hefty $200,000 to expenses. We don't take chances here. Our allowance undergoes quarterly fine-tuning to stay sharp against shifting customer and economic landscapes. Remember, in the financial realm, foresight is key. Ever wondered about the inner workings of related party transactions? These unique business dealings involve individuals or entities closely tied to the company, like executives or family members of key personnel. But why the special disclosure? Well, these transactions may not always play out on a level playing field. By shedding light on these connections, stakeholders can gauge the fairness and integrity of such deals. It's all about ensuring transparency and safeguarding the company's best interests. Who exactly are related parties in the business world? From top executives to major shareholders, from the influential board members to family and affiliates, the scope is broader than you might imagine. Identifying these key players is crucial for transparent disclosure. It's not just about executives, it extends to their family members and business connections too. Understanding this spectrum is vital for ensuring transparency and ethical business practices. In a nutshell, recognizing related parties goes beyond the obvious faces to include a network of intertwined interests. Ever wondered what exactly needs to be revealed about related parties in financial reporting? It's crucial to lay out the nature of the relationship up front, like if our CEO has a significant stake in another entity. Next, break down the transactions, whether it's management fees, rent, consulting, or loans. Quantify the dollar amounts involved and any outstanding sums at the period's close. Detail the terms and conditions, from payment schedules to interest rates, and compare them to dealings with unrelated parties. Lastly, don't forget to clarify the business purpose behind these transactions, showcasing how they ultimately benefit the company. Transparency is key in ensuring stakeholders have a holistic view. In the intricate web of business relationships, related party connections can wield significant influence. Imagine a scenario where a company purchases goods or services from an entity with shared ownership, a related party. This can raise questions about fair transactions and potential conflicts of interest. Transparency and clear guidelines are crucial to ensure ethical practices and maintain stakeholder trust. By scrutinizing these relationships, companies can uphold integrity and safeguard their reputation. Remember, vigilance is key in navigating the complexities of related party transactions. In the complex world of financial reporting, Chapter 5 dives into contingencies and their disclosure. Imagine a scenario where uncertainty looms over potential gains or losses, waiting to be unveiled by future events. From pending lawsuits to environmental obligations, these contingencies pose a challenge as their outcomes remain shrouded. Accounting standards step in to guide when to acknowledge and how to communicate these uncertainties. Will the company emerge victorious in the lawsuit? How hefty will the settlement prove to be? These are questions that echo the essence of contingencies. In assessing contingencies, consider both likelihood and estimability. Here's a decision tree to guide your approach. For remote chances, no disclosure needed. When it's reasonably possible, disclose but don't record. If it's probable and estimable, record the liability and provide details. Remember, the key lies in judging the probability. Probable means likely, reasonably possible falls in between, and remote means unlikely. Make your decisions wisely based on this framework. Ever wondered how to categorize future events in financial reporting? Let's break it down. In the world of probabilities, we have three key categories: probable, reasonably possible, and remote. When an event is deemed probable, it's a high likelihood, so record a liability and provide detailed disclosure. On the flip side, reasonably possible events are more than remote but less than certain. No need to record a liability, just disclose the nature and potential impact. And for remote events, where chances are slim, no liability recording is required, with minimal disclosure needed. It's all about navigating the landscape of certainty. In March 2024, the company faced legal action over alleged defects in our Model X line, seeking $5 million in damages. We stand firm against these claims, deeming them baseless after legal guidance. While an unfavorable outcome is possible, it's not deemed probable, hence no liability is recorded. If the litigation goes south, it could cost us between $1 million to $5 million. Monitoring this closely, we'll adjust our stance as needed. Stand by for updates. As we wrap up our discussion on building quality disclosures, remember these crucial points. Utilize disclosure checklists diligently to ensure compliance with accounting standards. When explaining critical estimates, offer full transparency on methodology and assumptions. For related party transactions, leave no detail undisclosed, be clear on relationships, amounts, and terms. Lastly, apply the contingency framework accurately by assessing likelihood and disclosing contingencies as per standards. In summary, meticulous attention to detail and transparency are key in creating robust financial disclosures. Welcome to our disclosure quality quiz, where we test your knowledge on key disclosure principles. In question 1, the CFO's rental arrangement and her daughter's consulting services both require disclosure due to their financial impact. Moving on to question 2, estimating warranty costs involves critical judgment based on historical data, which can significantly impact financial statements. Lastly, in question 3, with a probable loss and an estimable amount in a lawsuit, recording a liability is necessary. Remember, transparency is key in financial reporting. Disclose all relevant relationships and transactions to ensure accuracy and reliability.